The Successful Investor's Guide to Spotting Investment Trends and Turning Points. Technical Analysis Explained by Martin J. Pring. Part 1. Trend Determining Techniques. Chapter 1. The Definition and Interaction of Trends. Part 1. Trend Determining Techniques. Chapter 1. The Definition and Interaction of Trends. In the introduction, technical analysis was defined as the art of identifying trend changes at an early stage and to maintain an investment or trading posture until the weight of the evidence indicates that the trend has reversed. In order to identify a trend reversal, we must first know what the trend is. This chapter explains and categorizes the principal trends and concludes with a discussion of one of the basic building blocks of technical analysis, peak and trough progression. This technique is arguably the simplest of trend determining techniques, but in my book, certainly one of the most effective. Time frames. We have already established the link between psychology and prices. It is also a fact that human nature, psychology, is more or less constant. This means that the principles of technical analysis can be applied to any time frame, from 1 minute bars to weekly and monthly charts. The interpretation is identical. The only difference is that the battle between buyers and sellers is much larger on the monthly charts than on the intraday ones. This means that such trend reversal signs are far more significant. As we proceed, it will be evident that this book contains a huge variety of examples featuring many different time frames. For the purpose of interpretation, the time frame really does not matter. It's the a particular example featured on a 10-minute bar chart, the principles of interpretation are the same when applied to a weekly chart. A long term investor would never initiate an investment based on a 10-minute chart but can and should take action when that same type of technical evidence appears on a weekly or monthly one, and vice versa. Three important trends. A trend is a period in which a price moves in an irregular but persistent direction. It may also be described as a time measurement of the direction in price levels covering different time spans. There are many different classifications of trend in trend analysis, in technical analysis. It is useful to examine the more common ones, since such an understanding will give us perspective on the significance of specific technical events. The three most widely followed trends are primary, intermediate, and short term. Whenever we talk of any specific category of trend lasting for such and such a time period, please remember that the description offered is a rough guide encompassing most, but not all, of the possible durations for that particular type. Some specific trends will last longer and others for less time. Primary. The primary trend generally lasts between 9 months and 2 years and is a reflection of investors' attitudes towards unfolding fundamentals in the business cycle. The business the business cycle extends statistically from trough to trough for approximately 3.6 years. So it follows that rising and falling primary trends, bull and bear markets, last for 1 to 2 years. Since building up takes longer than the tearing down, bull markets generally last longer than bear markets. The direction of the secular or very long term trend will also affect the magnitude and duration of the primary trend. Bull markets generally last longer than bear markets. The direction of the secular or very long term trend will also affect the magnitude and duration of primary trend. Those that move in the direction of the secular trend will generally experience greater magnitude and duration than those that move in the opposite direction. Again, those that move in the direction of the secular trend will generally experience greater magnitude and duration than those that move in the opposite direction. The characteristics of secular trend are discussed later in this chapter and more fully in chapter 23. The primary trend cycle is operative for bonds, equities, and commodities. Primary trends also apply to currencies, but since they reflect investors' attitude towards the interrelationship of two different economies, Figure 1.1 The Market Cycle Model. This has been adapted from an idea first brought to my attention by the late Ian S. Notley of Yelton Fiscal Richfield, Connecticut. The primary trend cycle is operative for bonds, equities, and commodities. Primary trends also apply to currencies, but since they reflect investor attitudes towards the interrelationship of two different economies, analysis of currency relationship does not fit neatly into the business cycle approach discussed in Chapter 2. The primary trend is illustrated in Figure 1.1 by the thickest line. In an idealized situation, the primary uptrend, that is bull market, is the same size as the primary downtrend, that is the bear market, but in reality, of course, their magnitudes are different. Because it is very important to position both short-term and long-term trade investment in the direction of the main trend, a significant part of this book is concerned with identifying reversals in the primary trend. Intermediate. Anyone who has looked at prices on a chart will notice that they do not move in a straight line. A primary upswing is interrupted by several reactions along the way. These counter-cyclical trends within the coffins of primary bull market are known as intermediate price movements. They last anywhere from 6 weeks to as long as 9 months, sometimes even longer, but rarely shorter. Counter-cyclical intermediate trends are typically very deceptive, often being founded on very believable but false assumptions. For example, an intermediate rally during a bear market in equities may very well be founded on a couple of unexpectedly positive economic numbers, which make it appear that the economy will avoid that much feared recession. When subsequent numbers are reported and found to be wanting, the bear market resumes. When the subsequent numbers are reported and found to be wanting, the bear market resumes. Intermediate term trends of the stock market are examined in greater detail in Chapter 4 and are shown as thin solid line in Figure 1.1. It is important to have an idea of the direction and maturity of the primary trend, but an analysis of the intermediate trend is also helpful for improving success rates in trading, as well as for determining when the primary movements may have run its course. Short term trends. Well, short term trends typically last 3 to 6 weeks, sometimes shorter and sometimes longer. They interrupt the course of intermediate cycle just as the intermediate term trend interrupts primary price movements. Short term trends are shown in the market cycle model, Figure 1.1, as a dashed line. They are usually influenced by random news events and are far more difficult to identify than their intermediate or primary counterparts. Major technical principle. As a general rule, the longer the time span of a trend, the easier it is to identify. The shorter the time span, the more random it is likely to be. The market cycle model. By now, it is apparent that the price levels of any market is influenced simultaneously by several different trends, and it is important to understand which type is being monitored. For example, if a reversal in a short term trend has just taken place, a much smaller price movement may be expected than if the primary trend has reversed. Long term investors are principally concerned with the direction of the primary trend, and thus it is important for them to have some perspective on the maturity of the prevailing bull or bear market. However, long term investors must also be aware of the intermediate and, to the lesser extent, short term trends. This is because an important step in the analysis is an examination This is because an important step in the analysis is an examination and understanding of the relationship between short and intermediate term trends and how they affect the primary trend. Also, if it is concluded that the long term trend has just reversed to the upside, it may pay to wait between it may pay to wait before committing capital because the short term trend could be overextended on the upside. Ignoring the position of the short term trend could therefore prove costly at the margin. Short term traders are principally concerned with smaller movements in price, but they also need to know the direction of the intermediate and primary trend. This is because of the following principle. Major technical principle. Surprises occur in the direction of the main trend, that is on the upside in a bull market and on the downside in a bear market. In other words, rising short-term trends within the coffins of a bull market are likely to be much greater in magnitude than short-term downtrends, and vice versa. Losses usually develop because the trader is in a counter-cyclical position against the main trend. In effect, all market participants need to have some kind of working knowledge of all the three trends, although the emphasis will depend on whether the orientation comes from an investment or short-term trading perspective. Major technical principle. The discretion of the primary trend will affect the character of intermediate and short-term trends.